Okay, so this is Ron Williams, technical strategist from MIG Bank. Happy greetings to everyone here. Thank you for patiently waiting a few moments for our start. The presentation today is the last presentation for 2012. We've been holding these presentations every month for most of this year. And the presentation is Key Lessons from Past FX Trends this year and Trade Opportunities into 2012. Very exciting topic, and I'm very happy to be here with all of you. And just before we start, just want to quickly run through the traditional checks. For any of you that would like to contact me after this webinar, please feel free. I'm always happy to receive questions and to stay in touch with everyone. My email address is r.william@migbank.com. I'll try and reply to your emails as soon as possible. And then beneath that, MIG Bank also have various social media forums such as Facebook. I have a corporate Twitter and then LinkedIn. On Twitter, it's just rwilliams77, and LinkedIn, just type in my first and last name. You should be able to pick me up. And very last, there is a blog that I keep updating on forexstreet.net, which is part of FX Street. And please feel free to follow my ideas and thoughts on that. Okay, so let's get started. Just a quick word about the areas that I've specialized in. I've been in the industry for well over 10 years, and the main three areas that I focus in every day are on the screen: market cycles, Japanese candlestick setups, and DeMark indicators, as well as proprietary strategies. And just a quick explanation: market cycles is exactly that. It's focusing on timing, looking at past time patterns and trying to basically predict when in the future certain moves will take place. But also it's looking at economic relationships and intermarket analysis, so looking at the correlations between different markets such as the US dollar and gold and various other markets, just to get a very good intrinsic understanding of the market that we trade every day. Japanese candlestick trade setups, it's just a pattern recognition analysis, a way of actually being able to time the market. The majority of candlestick patterns are reversal patterns, and they can develop in just a few trading sessions. So what that means is you can really gain an edge just by getting these turning signals in a few sessions, which can be very useful in volatile markets. And then DeMark indicators, some of you who have attended previous webinars that I've given know that DeMark indicators is a very popular strategy that I follow. It was developed by a very well-respected individual called Tom DeMark, and most of his indicators are counter-trend indicators. And proprietary indicators kind of complement my focus on timing strategies within the market. Okay, so market cycles, pattern trade setups, specifically Japanese candlestick patterns, and then more advanced indicators such as DeMark indicators and my own proprietary strategy. Now, I traditionally ask this question because these webinars are increasingly attended by people across the world. I always like to know who we're sharing this knowledge with and how many people are maybe repeat attendees. So if I could just ask a quick survey question to all of you here. There's almost 100 people here in the forum, and I would like to ask the question: have you attended previous webinars or not, and where in the world are you dialing in from? So if you could just quickly type into the chat whether you've attended before or not, and which country are you attending from. I'll shout out some of the countries. So we have Canada, Mexico, London, North Carolina, USA, United Kingdom, Egypt, Canada, UK, Yerevan, USA, Africa, Japan, New York, London, USA again, and USA. We have an even split. Thank you very much from Houston. Apparently a fan. Germany, Czech Republic, Texas. We have quite a big mix here, and I think it's an even split between the USA and England. We have a few people from Asia, Japan, and just recently Singapore. And I think someone's asking where I'm based in. I'm based in Switzerland here in Europe. And that's basically where the headquarters of our bank is located. Okay, so a big welcome to all of you there. We have a truly global multinational audience. And I think it's a 50-50 split between people who have attended previously and people who haven't. So welcome to people that have attended time and time again. Thank you very much for attending this webinar and continuing to follow my analysis. And for some of you new people there, again, welcome, and I really hope you enjoy this session. Please feel free to ask questions throughout the session. Usually if I run out of time, I'll hold some questions back until the end, but please feel free to ask questions throughout the session. If I don't get to answer each of your questions, please feel free to email me on the address that I mentioned at the start. Okay. So this is basically what we're going to try and get through in the time allocated to us. We're looking at 3 parts. The first part is just looking at past FX trends. I'm going to quickly go through the performance to look at the best and worst performers of this year. Part 2, we're going to look at trade opportunities into 2012. This is just going to be a quick summary of what I think is going to be key themes into next year. But of course, I will follow up in a later session, in a follow-up session in the months into next year. And then part 3, if we have enough time, I'm just going to have a quick point on the volatility that we have seen in the last few months and that we're likely to see into 2012. Now, part 3, I'm dedicating a full webinar on in January, the 23rd of January, so please feel free to attend that one, where we'll be focusing on how to basically successfully trade in what is likely to be a volatile 2012. So that will be start of January, January 23rd. I'll give you a little taster in part 3 of this webinar if we have enough time, but there'll be a full session on that on the 23rd of January. Okay, so let's start. Just a quick disclaimer that none of the information here published constitutes a solicitation or offer to give advice to buy or sell, and it's purely for informational purposes only. So this is just a legal disclaimer that I'm obliged to read out just for the purposes of the analysis that I'm going to show. Okay, so here's an open question. I always like to ask interactive questions in my sessions, keep you thinking and also learn from you guys as much as you're learning from me. And the question I asked you today is, out of all of these currencies, FX majors, commodity FX, frontier or emerging market FX markets, which of these currencies do you believe are the best and worst FX performers for this year? So which ones do you think have done the best or have maybe underperformed the worst? So we have FX majors such as the euro, Japanese yen, sterling, Swiss franc. We have commodity FX currencies such as the Aussie dollar, Canadian dollar, South African rand, Norwegian krona. We have frontier or emerging markets in Asia, Eastern Europe, South America, which covers a cross between China, Hong Kong, Turkey, Eastern Europe, Poland, Hungary, Czech, and South America we have Brazil, Mexico, Argentina, Peru, Chile. So we're really looking at the world here, the extended major currencies around the world. Which ones do you think have performed the best, and which ones do you think has performed the worst? Strength and weakness, yes. So we have a few people saying Swiss franc the best, euro the worst, Australian dollar, Norwegian krona, Singapore, Brazil. Someone's just said the Australian dollar. Another person saying Australian dollar. So we have best is Swiss franc and Aussie. This is all against the US dollar, by the way. So this is dollar block currencies. Another person saying Swiss franc and Japanese yen. Japanese yen. Okay, so we have a nice mix there. I think most people are either choosing the popular euro currency as maybe the worst performing. Some, actually a lot of people are saying the Australian dollar as being the best performer. And some people are saying, well, we haven't really gone anywhere. One person asking the good question, what commodity does Norway do? Oil, oil, and oil. That they're synonymous for being big oil producers and hence a commodity player in the globe. And one person we have here saying rupee has been bad, gold, and so on. Okay, so I'll let everyone here read the answers in there. I haven't put gold or silver in there, but keep that in the back of your mind. Of course, gold and silver have been very good performers in the commodity complex, where they've really performed well. Now, to answer the question, which currencies have been the best and worst FX performers in 2012? The answers are on your screen as we speak. So, the top 5 in terms of percentage performance year to date: Japanese yen, Peruvian sol, Chinese renminbi, Norwegian krona, Swiss franc. These are the best performing currencies this year to date. The worst performing currencies year to date: Mexican peso, Polish zloty, Indian rupee, Turkish lira, and South African rand. Now, how many of you are surprised? Just a quick yes, no, maybe. Anyone surprised by the figures I'm showing you here? Some people are saying yes. Okay. Now, what do you notice about, so other than the currencies I've just shown you, what have you noticed about the best performers this year? Can anyone tell me? What do you notice about the best performing currencies this year? Euro is just there at number 9. So some people are saying risk aversion, good trending, export economies, bank intervention. I mean, the currencies which have performed the best this year, what do you notice about the column? So if you can just see there, between 1 to 5, the best performers this year have been up to 4.4%. So they have performed up to 4.5% this year. That's been the best case scenario. Yeah, so I think Greg's just basically answered the question very well. It's a simple question, simple answer. The best performing currencies this year haven't performed that much. The best case scenario in the entire 2011 year has been 4 and a bit percent. So you can just imagine that you have this in your portfolio, you're trading these currencies, 4% in the year. Now compare that to the worst performers. This is based on spot FX prices. The worst performers this year has been minus 18%. So you see that the big disparity between markets which have moved up against the dollar and markets which have moved down against the dollar. And you can see that there's a massive kind of negative skew here, where we have had some serious underperformers in the market based on traditional trends that we may have been trading in the first half of this year and certainly in 2010. So some people are saying, so conclusion is the US dollar has performed well. Yes, I would agree with that. It is starting to recover quite well across the board, not just against the dollar index, but actually across each of the isolated different currencies, be it major FX within Europe, but also the Asian currencies and even the South American currencies. Another person saying in bad times people are fast dumps, the downloads are more extreme. Agreed. The changes in trends have taken place very quickly in the second half of this year as risk appetite started to unwind, and that is what we're now seeing. A lot of the traditional trends have changed, and that's what we're seeing on this screen here. If I had shown you this performance screen from the first half of this year, you would have seen a different picture. But because we're looking at year to date, i.e. the whole of 2011, we're basically looking at the worst half of this year, which has been pretty volatile, and themes have been changing quite a bit. Now just going to read a few of the comments. Someone's saying, is surprised to see Brazilian real and Indian rupee among the worst performance. I still don't understand how you measured this best and worst. Just for those who are just asking the question how this is measured, it's just based on percentage performance of FX spot prices. It's just a very simple measure of how many percentage points has that currency moved up or down for the year. Is that clear? Okay, I'm just going to move on from this. So this is basically what we have here. We have the top 5: Japanese yen, Peru, China, Norway, Swiss franc, and what that shows is that the best case scenario this year has just been 4% gains in FX spot value. The worst performers, we've had Mexico, Poland, India, Turkey, South Africa, and the worst case scenario this year has been the complete opposite of what we're seeing on the upside, minus 18%, so a massive disparity. And as some of you have noted, the themes that you can pull out from this screen straight away is that worst performers have been significantly stronger, partly because maybe people are faster to dump traditional trends and downwards are more extreme. Volatility has increased, but what we are seeing is US dollar starting to recover against each of the currencies that we've traditionally traded against the US dollar. Okay, now what I want to show you is the best and worst FX performance in 2010. And you can see that point that I made, that there was a brighter day previously, and that was 2010 and early part of this year, 2011. And you can see here, clearly we have an exact opposite situation where the traditional markets that we were trading, the traditional trends, were trending positively. Here you have Japanese yen, Australian dollar, Malaysia, South Africa, Swiss franc, Singapore, Taiwan, Chile, New Zealand, all having really strong trends, and the best one being Japanese yen, plus 14% in the year of 2010, so last year. And you can see the worst performers actually aren't as bad as this year, if we're looking at just the universe of currencies that I mentioned at the top. And the worst case scenario in 2010 was only down almost 9%, 9 or 10%. Okay, so that's just a quick kind of message from me in terms of last year, best and worst FX performers in 2011 and 2010. Okay, now what I want to highlight here is the fact that in this increasingly kind of underperforming world that we're living in, certainly within the second half of this year and more than likely into 2012, I think the best analogy that I can share with each of you here is this picture here of a forest fire. And this is the forest fire picture taken by National Geographic back in 2008. And it's just showing you how each of these trees have caught fire. And what you need to be thinking about is that in this kind of environment where each of the trees are being burnt by this forest fire, you're looking for the better of two evils. You're looking for the tree which is least burnt. And so what that basically means is that pretty much everything in the market, everything in this forest has caught fire. Everything in this market environment has been impacted by negative contagion by the economic turmoil that has started in the US but then rotated into Europe, and then to some extent is pressurizing some of the frontier markets in Asia and potentially South America. So you can see here that we're all caught in this forest fire, and this forest fire basically teaches us that it's very much a relative world. We're looking at relative performance. Things aren't as good as we remember them as they used to be, but we're looking for that one market which is maybe an extra percentage point better than the other market. They all might be falling. They all might be injured from this fire, from this economic contagion, but we're looking for the one which is slightly better than its counterpart. Is everyone clear on that analogy? So we're just saying forest fire, similar to economic contagion, and it's just teaching us that the world that we're in is a different world. It's a relative world where performance is much less than it used to be, and we have to basically just look for the relative performance which is slightly better than its counterpart. What that means is that sometimes the economic or technical story might not be the story that we are really attracted to. So, for example, when we're looking at the US versus Europe, which one do you prefer? In such a weak beauty contest, we have to choose what is available to us. And so sometimes we have to temper our economic and our technical views in order to actually get that relative outperformer, which might just be a few percentage points. Remember what I showed you at the outstart of this presentation. This year, certainly the second half of this year, has been a massive change in trend, increased underperformance, and a lot of volatility, negative volatility taking place. So we really have to choose as smartly as possible, but we can't pick the kind of best case scenarios that we used to have in 2009 and 2010 during the recovery period. Now, just to explain this point that I just highlighted, I'm going to just click here, and each of these trees are going to symbolize currencies that you look at on a daily basis. US dollar up front, Europe on the side, and then British pound. And so this just highlights the point that each of these regions have economic contagion and economic turmoil. But on a relative basis, one of these regions is going to outperform the other. And remember that we're in the FX world here. So within the FX markets, it is one country versus the other. Now remember, I was talking about rotation. Each of these currencies basically have a degree of risk. And that's very true within the US, where things seem to be getting from bad to worse. Certainly within the economy and the debt situation. But then Europe, you have a problem where you have each of the individual states unable to reach consensus views. You have the core countries such as Germany and France now actually starting to feel the pain from the peripheral countries, namely Greece, Portugal, Italy, and a few other countries. And then, of course, we have England, which every now and again is hitting the headlines very recently with the banking in the UK increasingly under pressure from debt issues. But at the end of the day, when we're looking at the FX currencies, we're looking at one country versus another, and so we do have to think of this in a relative way. And also we have to keep in mind that each of these regions have risk, which is rotating from one region to the next. We're all in the same situation. Now, this is just a quick example of volatility for 2011, and we can see here that the most volatile market, this is based on historical volatility for the year, percentage historical volatility. We can see here that Japanese yen, Australian dollar, and Malaysia, South Africa have been some of the most volatile markets this year. In terms of negative volatility, Hungarian forint, Danish krona, and the euro, and certainly some of you will relate to the euro, which is just showing you here that we've had volatility of minus 6.56%. Japanese yen, we've had positive volatility of 14.6%. Now, of course, Japanese yen increased volatility on the upside is showing you Japanese yen reaching those record highs, which the Bank of Japan Ministry of Finance is really trying to fight hard because it's starting to impact the competitive export-led economy of Japan. So just a quick question about the meaning of the percent. It's historical volatility. It's the percentage of historical volatility for the year on each of these currencies. I can answer some of these technical questions at the end of the webinar. But here I'm just showing you positive volatility, the white swan that you can see on the left-hand side of the screen, and then negative volatility, the black swan, which you can see at the bottom right-hand side of the screen. Yes, you can actually use this data to actually maybe rank a currency universe, and I certainly do so on a regular basis just to be able to kind of make sense out of any kind of themes that might be taking place in the market and changes in trends. So I tend to look at percentage performance, but also volatility measures and a lot more. I'm showing this to you at the moment just to give you a quick snapshot of what's happened this year in terms of best and worst performance, but also volatility, positive and negative for the year. Okay, now I'm a big follower of cycles, and I believe that cycles in the market is pretty much the reason why we're seeing such a shift in trends and such a big increase in volatility. By definition, if a long-term or medium-term or short-term cycle altogether shift at the same time or within a certain amount of time frame, you do get an increase in volatility as that ground underneath you starts to shift, starts to change. And so here I'm showing 3 cycles. Long-term cycle, which is the big fat blue line, and that tends to be multi-year. The turquoise cycle, which is a medium term, tends to be up to 12 months, the 1 year. And short term, which is the dotted red line, which is basically anything from multi-day to multi-month. And I'm just basically showing you here as what is the change in cycle that has potentially led to increased volatility. And what I'm talking about here is the economic situation that we're in and the market situation that we're in. So right now I believe we're here. So I believe the Western economy and markets are roughly on the up part of this recovery period, which is just about to move into a downswing mode into this longer term downtrend, longer term cycle. Is everyone kind of okay with what I'm just visualizing here with you? This is clear to everyone in terms of where roughly I believe we are in the economic and market cycle within the Western market? Yeah? Okay. Now just to give you a better roadmap of this, when I say that I believe we're roughly within the top part of that peak, that upswing recovery, which is about to turn lower, I'm going to give you dates before and after this period, just to give you a good, clear roadmap for where we were, where we have been in the past, and where we might be moving to in the future. So I believe that 2007 is roughly the top of this cycle. Just after the good times, things turned down after very kind of big boom period. Then we had 2009, which kind of marked the bottom of that down cycle after the financial crisis. We had the Lehman debacle and various kind of record volatility and contagion taking place during that time into 2009 from 2007. But basically what we've experienced since 2009 into 2011, and certainly maybe the first half of 2011, has been the recovery period. And so yes, as someone's just asking now, you mean the cycle down? I believe that that's what we're going to experience into 2012. So basically 2007, the top of the major cycle, and that really, everything before that was the boom period that we experienced during the 90s and early 80s even. After 2007, we had the financial crisis, which basically led to economic contagion turmoil into 2009. But between 2009 and 2011, that was really kind of the recovery period, which we experienced probably into the first half of this year. Second half of this year has been the change in market performance. We've weakened quite a bit on some of the key markets, and volatility has increased considerably in the second half of 2011. And basically going into next year, I believe that at least within the first 6 months of 2012, we will get a repeat of 2008, which was pretty much part of that economic contagion turmoil that we had previously. Someone's just asking what years are far right and far left. I'll come back to that question at the end, just for the sake of time. But is everyone just clear on this macro cycle that I'm showing you here, long term, medium term, and short term? And I'm just saying that currently I believe where the Western markets are roughly where that red arrow is, and that was just basically at the top of a recovery period from 2009, from the 2007 financial crisis, and I believe they're about to fall back into this bear cycle, certainly within the first 6 months of next year. I want to make sure that's very clear to everyone here, just so you know what to expect. Now, I don't mean to be bearish or negative, in terms of my sentiment, but I'm just kind of letting you know that it's more than likely to be a winter period, so better just get those coats and that winter clothing and just prepare for what is likely to be a repeat of 2008 into the first 6 months of next year, 2012. Okay, now just to quickly kind of affirm that view, I'm showing you a chart here of US GDP, quarterly GDP, which over the last 30 years. Now I tend to look at a lot of historical charts, but if you're looking at economic charts, I really do encourage you to look at long-term charts, at least 20, 30 years worth of history. And what this shows you is, just for some of you that maybe not have seen GDP historically, anytime this white line falls below the 0% line is basically showing you a recessionary period. Now specifically, the definition of recession is any time GDP, quarterly GDP, is negative for 2 quarters, 2 consecutive quarters. That is negative GDP, and classified as a recession. Now, the red circles are just highlighting previous recessions that have been experienced in the U.S. And remember, the U.S. has traditionally been the kind of bellwether for the world economy. Of course, that is now changing. China's now, for some years, taken leadership over the U.S. But generally speaking, what happens in the U.S. tends to affect at least most of the Western market. And so if there's a recession in the U.S., that tends to influence Europe and some other markets, which depend on U.S. consumption. Now, what we see is that roughly every 10 years or so, there is a recession, and probably the most interesting recession is the one I've highlighted there in the 1980s, where we had a double dip recession. Not only did we have a double dip recession, but we also had very negative, very extreme, weak GDP growth. It was roughly in the -8% region. And the reason why I highlight that to you is because that's very similar to what we experienced in 2009 after the financial crisis in 2007, when US GDP really did fall to extremes, actually extremes beneath the 1980 double dip recession. And so a lot of market experts, including myself, were going on the record saying that because GDP, because the growth of the USA and most Western economies had reached such extreme lows, the rebound from these extreme lows, from this extreme low base, would more than likely be unsustainable. So any growth, any rebound in growth in the US or European market from the 2009 low, recovery low, was, in my opinion, and a few other colleagues that share this opinion, was going to be unsustainable, just because it was such a big rebound and it was so negative in 2009 from the financial crisis. And so what that means is, for some time now, US GDP and European GDP has been weakening and is more than likely to mean revert back into negative territory below 0%. So all those people, all those experts that are looking for positive growth into 2012, 2013, I think will be proven wrong. And we are likely, at least from my technical and economic perspective, going to experience negative growth, but also potentially a double dip recession, similar to what we saw in the 1980s. And of course, the economic situation is different to the 1980s, but in terms of the structural rebound and potential double dip implications, it is very similar. Is that clear to everyone? Just in terms of US GDP and just general growth within the Western market, potentially becoming negative into next year in 2013, and of course that will have an effect on the currencies that we trade on a regular basis. Okay, great. Now this slowdown in growth is going to affect a lot of the commodities that we've been heavily leveraged in, and all these kind of very strong trends. I would recommend that you look at commodities which are highly correlated to economic growth, such as copper, which is very correlated to industrial growth. because of the consumption for industrial metals such as copper, but also markets like oil. Now I'm showing you oil because I think most of you look at oil or at least trade oil, and this is a chart I just literally put into the presentation just moments ago, and it's just showing you that crude oil is currently under pressure into that $100 mark. Now I believe that we're going to have sharp setbacks in oil over the next few weeks, and this will be across most commodities, be it energy, industrial metals, and certainly precious metals. I'm actually most negative on gold, silver, and some of the other precious metal complexes. But just keep in mind that some of the commodities which are heavily linked to growth, economic growth, such as oil in terms of energy consumption or copper in terms of industrial consumption, keep in mind that these markets are likely to fall quite violently over the next few days and weeks. The only caveat for oil is if some geopolitical risk were to take place potentially in Iran or the Middle East, then of course there's a risk of a potential spike in oil, and that's more of a black swan event that may or may not take place. But just for the price information that is on the screen at the moment, I believe that oil is likely to be under pressure into this $100 psychological mark, which is also an important Fibonacci golden ratio, 61.8%, and another ratio I look at, 66%, just providing very strong resistance on that rise in oil. I believe that oil will actually fall down into key support levels at $90 and $83. Now, the $83 mark is previously where the crisis in Libya took place. Remember earlier this year during spring when we had the revolution situation take place within the Middle East. I believe that we will revisit those lows around the $83 mark. So that's the view for oil. Technically under pressure, unwinding from overbought conditions into that psychological level at $100, but also a key Fibonacci golden ratio. From the economic macro side, keep in mind that oil is also likely to come under pressure if we have a further weakening in economic growth. Now I'm just going to quickly go into trading opportunities within the remaining time that we have, and then just spend just a few moments on the part 3, just to give you an idea of what to expect for the webinar scheduled for the 23rd of January next year. Now this year has been pretty much like a football match, a game of two halves, and I've used this slide in many presentations just to illustrate the point. The first half of this year of this game, of this financial game, has been risk on, this binary bet that people in the market increase their risk appetite. Second half of this year has been an unwinding of that risk. Now, by no means have either of these moves, risk appetite on, risk appetite off, by no means have they been linear in fashion. It has been a fairly kind of on and off volatile environment. But just keep in mind it has been a game of two halves, risk on, risk off, and it's been a binary trade in either of those themes. Now, most recently, the signal for me of further risk off, unwinding of risk appetite in the markets happened in October 31st, not too long ago. And the key signal for me was when markets which are correlated with risk appetite, such as the S&P 500 and the Eurodollar, failed into their long-term 200-day moving averages and key chart levels, which I haven't highlighted here, but I'll mention in further slides. Now, what is so significant about October 31st? Can anyone tell me what happened around the end of October in Europe and in Japan? What happened? Can anyone tell me? What happened at the end of October within Europe and within Japan? Any guesses? I'll hold the question open just for a few moments, just in case some of you want to try this question. Anyone want to give a guess? What happened at the end of August end of October this year. So the earthquake was in early spring this year. QE probably turned to stealth. So it wasn't so obvious when there was quantitative easing. But well done, Fernando, and welcome, Jeff. Intervention on the Swiss franc and the Japanese yen. It was actually more intervention on the Japanese yen, and also the European meeting. Now, within Europe, this is probably the key thing. Europe had a very key meeting. They've had many meetings, but this was key in that this was the one meeting that they were going to discuss an increase of the bailout fund to X trillion, and that positive news is what actually encouraged these markets to accelerate to the upside. It was on the back of that positive news that suddenly, out of all of this turmoil, the European leaders, political leaders, were able to secure the bailout fund and increase that fund to X trillion. And so markets such as the S&P and Europe, the euro, accelerated in value on the back of that positive news. Now, what happened just days afterwards, which is what makes this so psychologically important for me, is that the market then literally just fell off the cliff afterwards. So when most people were becoming positive because these markets had accelerated on this positive economic news out of Europe, and then the technical people were looking at this long-term 200 moving average, you could see that a lot of people were getting ready to kind of turn long in bigger time frames. But then we had that failure into the 200 moving average and then a reversal lower. Now, one of the attendees, Mike, is asking, does this new forecast later into yen bearish, dollar positive? Yes, I am bearish Japanese yen over the next few weeks and very positive on the US dollar as well. So this is just basically a key signal that I'd encourage you to look at. October 31st, look at the news that was taking place, positive news out of Europe. The market bought on that headline and then sold, bought on the rumor, I should say, and sold on the headline. And then what happened days later, Bank of Japan, Ministry of Finance intervened, unprecedented amounts of yen, roughly 4 trillion yen, and that created a big shockwave in the market and a big unwinding of risk. Now, it's important to keep in mind that we are currently in a new volatility cycle, which is likely to take us into 2012. Keep in mind, I'm saying increased volatility for the first 6 months of next year are more than likely. This is what my analysis suggests is highly probable. And here I'm showing you two proxies of volatility. The VIX index, which is based on the S&P, the US index, and the VSTOXX, which is based on the EURUSD. And this is just basically a measure of volatility based on the option market. And in white, I've basically highlighted different stages of volatility, 1, 2, and 3. And here you have the third period starting in the second half of this year. So remember, I keep on saying 2011, this year, has been a game of two halves. And the second half has been when we've had an unwinding of risk appetite and an increase in volatility. So here is the evidence based on these volatility indices based on the equity markets. Now, even more compounding evidence that you should start to be a bit more cautious on the trades that you're actively in is this chart here, which shows you the silver-gold ratio overlaid the S&P. Now, silver-gold ratio tends to be used as a measure for economic positive or negative events in the market. Silver is generally seen as an industrial. When silver goes up, it tends to be during economic growth times, and when silver falls down, it's usually during recessionary times. Gold is usually seen as the safe haven play. So again, if you were to look at silver versus gold, silver rising basically means industrial growth. Gold rising tends to be safe haven play. What this shows is that each time this ratio turns down, it tends to turn before the equity market. So you get an early sell signal or warning signal on the silver gold ratio. So I encourage you to look at this ratio. As you can see in 2008, the ratio turned before the US stock market did, before we had that massive sell down in 2008, which I believe is going to be similar to next year. Fast forward to now in 2011, you can see that the ratio actually had a massive run on the upside, but then peaked in spring of this year, roughly around the time when silver capitulated about 30% in a week from that $50 mark. And it's continued lower ever since. So we've seen lower lows on the silver gold ratio, and it's about to make a new low. Meanwhile, the S&P and most Western markets have moved sideways to down. So just keep this in mind as further evidence on bearish moves on the downside in the weeks and months to come. Someone just asked, Talon's just asking, do you think the S&P will be able to keep Euro-Swiss level at 121, or as they've hinted 124? I'll come on to that question in a bit, but just my short answer is, I believe there is a probability that they move in at 124 just before Christmas. That's the rumors, that they might come in with a early Christmas present for market participants, and move the intervention level even higher. But the big question mark, which a colleague of mine, Bijoy Carr, who covers this Franc, believes, as well as I do, is that it will become increasingly hard for the Swiss National Bank to actually maintain that intervention level if we start to get this increased sell-off in the market or turmoil in the market, because there might be a shift back into Swiss francs. Now, personally, I think there'll be less of a shift back into Swiss francs and various other traditional assets like gold and the Japanese yen. I believe that the shift will actually increase more into the US dollar over Swiss franc, Japanese yen, and gold. That's my personal view. Does that help answer your question, Talon? So short answer, I believe we might likely see another intervention level at 124 before Christmas, but I believe that any potential change in safe haven flows in the Swiss franc will likely be less than previously seen, and that we will see an increased shift, a domino shift into the US dollar in an increased flight to safety. Okay, and this is my quick perspective on Eurodollar. Keep in mind that the reason why the failure into this 200-day moving average was so important is that Eurodollar also reversed from a 2-year trend. And it's what I call the kiss of death, when you have this massive structural level which has supported the market break down and then retest. Whenever you get a breakdown from a structural level and then a retest of that level, it's pretty much a kiss of death. It's that final capitulation move where you can expect the market to make really kind of new lows in this context. So I do believe that Eurodollar's reversed from the 2-year trend, and its retest of that trend, the kiss of death, is likely to offer further downside into 130 very quickly. I think we can see that in a very short space of time. And then the 2011 major low at 128.70. I'm even more bearish on that into next year, but I'm just going to hold back my forecast until I actually publish them on the record before sharing it out here on the forum. Now, someone's asking me, when as a historian do you feel interventions are temporarily effective, if at all? I've written a big special report on covering Japanese yen and interventions from the Ministry of Finance, saying that interventions only have a short-term effect, and history has proven that. And I've studied all the interventions taking place on the Japanese yen for the last 10 years. If you would like that report, just send me an email, Mike, and I can email it to you. But I think in the case of Japan, the intervention might actually work over the next few weeks and months, because there's a structural cycle change in the Japanese yen which will help weaken the Japanese yen and obviously help the Bank of Japan Ministry of Finance in their mandate to weaken the currency. Okay, so Eurodollar reversal from this 2-year trend, targeting 130, 128.70 and even lower. In future webinars, I'll talk about other levels that I'm looking for. Keep in mind that the big reason why euro is weakening against the dollar, even though things in the US are getting worse as we speak, the rotation of risk is currently on Europe. Remember that picture I showed you? And so that's partly down to the sovereign default risk, which is starting to accelerate to new highs. This is showing you 5-year CDS in the peripheral markets, specifically Greece. You can see the red line there is Greece rising over 5,000 basis points in 1 month. That has just happened. Greek CDS has popped to all-time highs and risen by 5,000 basis points in just 1 month. Now, this is the second time that Greece has done this. And I was asked in the CNBC interview a while ago, what does this mean? I really do believe this means that not only is the market perceiving default risk in one of these countries, but the reality of default risk taking place into next year. And then, of course, the consequences that might happen from that. Keep in mind that this is going to add more contagion on related countries such as Italy, Spain, and Portugal. The orange line there, just looking like it's flatlining, is Portugal. Now, it only looks neutral because of Greece. But once you take Greece out of the equation, Portugal is probably the next country about to pop to new all-time highs on its CDS, which is basically a measure of default risk. So this is why euro is weakening against the dollar, and that's why I believe euro-dollar is likely to fall much lower into next year, despite the problems in the US. And this is adding further unwinding of risk, and we're seeing markets like the Australian dollar, which is correlated to risk appetite and just general commodity resources. Currencies like the Australian dollar and the Canadian dollar and these resource-rich currencies are starting to unwind from very strong highs. And you can see here Aussie dollar, I believe, targeting 0.8770, which is basically the one of the major lows that we saw in 2010. So keep in mind that some of the commodity currencies, certainly the Australian dollar and the Canadian dollar, are mean reverting from their strong highs. So this will be recorded, by the way, so any of you that need to watch this again, please feel free to. And all the best, Anis. I hope you enjoyed it so far. Okay, now all of this increased turmoil that we're likely to see, we have seen in the second half of this year and we're likely to see into next year, is increasing safe haven flows, but safe haven flows have changed. No longer are they strong in gold or Swiss franc, or even, I believe, in the next few weeks in Japanese yen. So there's a wave of change in safe havens as the number of safe havens start to run out. Put simply, the number of safe places around the world to invest your money are starting to decrease. So just a quick example, the traditional market gold, as we speak, has triggered a major sell-off this year. Today, I should be saying. My apologies. Thank you, Mike, for the positive feedback. Brilliant job. Thank you very much. Really appreciate the feedback. So I believe that gold is finally actually playing ball with my market call and approaching that $1,600 level. The key trigger levels, I believe, beneath 1,600 and certainly 1,530, we're going to have a massive decline on gold, which will likely take us into $1,300 and worst case scenario, $1,000. Any of you that want to ask further questions on why I'm so bearish on gold, please just send me an email. I can send you a special report that I've written on that. But keep in mind that if we see a confirmed move beneath 1530, which takes us to 1300 and 1000, that will be more than likely a buying opportunity into summer of next year. Gold has, in my opinion, turned into a risk asset. It is not the safe haven asset. It's not played the traditional safe haven asset as we've known it to be over the last few months. And like all markets, any market which accelerates dramatically, that move was always unsustainable as mass psychology starts to unwind from those record highs. So just keep that in mind. Gold has turned into a risk asset because it reached record highs into that $2,000 level or just beneath. Keep in mind that this is very similar to 2008 when gold hit $1,000 and basically moved sideways for 8 months. So I believe that gold is likely to fall further beneath 1530 into 1300 and 1000, and I think we're likely to have about a 6-month or so consolidation period, which offers you a buying opportunity into summer of next year. Swiss franc, of course, the currency wars continue in Switzerland and in Japan. Switzerland has been very successful in actually reducing the value of its currency, and it has done by over 30% against the US dollar. A lot of people have forgotten that. The Swiss franc has been devalued by just over 30% against the US dollar, and is probably, I think, likely to continue higher into parity, into that 1 mark. So for obvious reasons, I believe that safe haven flows are going to continue to decrease into Swiss franc. Japanese yen, I think, is the biggest story to date. If any of you are looking for the big trade, I really believe it's the Japanese yen, but of course it's been the house of pain trade. There's been a lot of volatility, so you do have to be very careful with this currency pair. Just keep in mind that there's a multi-year pattern which anticipates a breakout above 80 and 85 on dollar yen, but this is also part of a much larger big picture, Japanese yen verging on a 40-year cycle. Now, I've written a report about this. I can email to you if you just shoot me an email afterwards. And I should be appearing on CNBC this Wednesday morning, CNBC Squawk Squawks, actually talking just about this major cycle reversal on the Japanese yen. So this would be Japanese yen weakness across the board. This would be broad Japanese yen weakness. But also this big change in mass psychology will actually mean less safe haven flows into Japanese yen, and even probably a change in the carry trade, popular carry trade, which people have been using the Japanese yen for several years. I believe that we start to get carry trade from back into US dollar. People start using the US dollar as a funding currency into the next 6 months of next year. And Japanese yen weakness, and I believe, of course, if we get a move above 80 and 85, that we will get a move well into the 94 region. Just a quick point that I'll make here on currencies such as dollar yen and euro yen, because everyone in the market is pretty much watching these markets, and most people are looking for a major bottom. Keep in mind that it might be better to actually look for smarter trades. So either wait for the market to confirm, or maybe look at alternative option strategies just to hedge yourselves. And just at the end, US dollar recovery targets 80. We're starting to move up to that 9-month high area, and keep in mind that we're going to, I believe, see up to 30% gain in value on the US dollar, on the dollar index. Keep in mind that the currency weighting on the US dollar, the second largest weighting in the US dollar, is Japanese yen. So if we do see a massive turn in Japanese yen weakness, that will really be positive for the US dollar. And I'm just wrapping up here. FX Street guys are saying we're out of time. Keep in mind that we're also seeing Asian currencies starting to weaken against the US dollar. This is a currency index of Asian currencies developed by JP Morgan, showing you that it's just about to break out of a multi-year trend. And if that happens, of course, we will see further unwinding of Asian currencies, but also growth around some of the Asian but general emerging market regions as global economic growth starts to unwind into next year. We don't have time to talk about part 3, but I'll just quickly shift to the last part. Keep in mind, I have a webinar scheduled for 23rd of January at 4 o'clock, Successful Trading in the Volatile Year of 2012. Please, if you would like to attend that, always an honor and a pleasure to share knowledge and learn from you guys just as much as you learn from me. And try and sign up in advance, because we tend to get full early on. If you would like to email me with any questions, please feel free to email me on r.william@migbank.com. Keep in mind that MIG Bank also has social media outlets, Facebook, but also I have a Twitter account, rwilliams77, and a LinkedIn is just typing my name. You can also catch me on forexstreet.net, which is the FX Street blog. And if you're interested in any of the charts I've used today, I can email it to you. And just lastly, we can also put you on a 1-month free trial if you just shoot me an email. My final point is enlightenment through realized knowledge. This is one of my most important mantras in life and within this industry. Really enjoy giving these webinars. Thank you, FX Street, for inviting me. And apologies for overrunning a little bit. Thank you very much. Enlightenment through realized knowledge. It's been an honor and a pleasure. Happy New Year and happy Christmas, everyone.